What's up, guys? James here from jamesdforesight.com, and as promised, we're going to go over the money and payments white paper that the Federal Reserve did for a possible central bank digital currency. And so we'll just head straight over to the screen share for the PDF to get on started. Let's see. Okay. So one of the things that is very important to note for a central bank digital currency, right, is the fact that what is kind of defined as, because one of the things that I've noticed people talk about a lot. Um, and before I forget, I'm going to change the screen so that it's bigger for you guys. Um, but essentially, people were like, "Oh, we already have digital money," but that's not what the problem is, or that's not what the difference is. So what we have now, and we'll go into it in this specific video as well, and is even as the Fed defines it. So a central bank digital currency would differ from existing digital money, um, basically because it would be a liability of the Federal Reserve and not a commercial bank. So the money in your bank account is a liability of your bank, not the Federal Reserve, right? Um, and it's kind of worth distinguishing between this is the money that's available to you. And so, like, there's another form of like more digital money, I guess, which you could think of for commercial banks is the bank reserves, which is so. I'm going to wait until that stuff is in front of us, just so it's easier to see and try to keep this video structured and not go down on tangents. Um, But basically, and just kind of a range of benefits that they're talking about is basically it could provide households and businesses with convenient electronic forms of central bank money with the safety and liquidity that would entail, give entrepreneurs a platform on which to create new financial products and services, support faster and cheaper payments, including cross border payments, and expand consumer access to the financial system. So one of the things that we'll go over periodically throughout the rest of these videos, because I kind of broke up this 40 page or so um, white paper into sections so that we'll go over, it's not just one like 3 hour long video or whatever happens to be. Um, but basically, a big reason they're doing this, or one of the reasons that we'll get into in probably future videos, is like financial inclusion to some of the words that they talk about in there. They give some data and kind of, uh, the actual numbers are presented of what that's needed, I guess. I don't know. I did a terrible job articulating that, but they give actual percentages on like how they're measuring financial inclusion and stuff like that, which I'm not here to argue that. Basically, I just want to go over the actual white paper itself and was with respect to central bank digital currencies because that's what I'm more interested in. And also, as a disclaimer, they want to state that this is not intended to basically say that a CBDC is imminent. Basically, just that they're looking at it. And I did do a previous video months ago, I think, where one of the boards or whatever for this for the Federal Reserve is working with the section at MIT over. It was like a processor or something. Um, but we'll get into that later because I actually talk about the same thing. So this is where we're talking about the existing forms of money that we currently have, right? And so central bank money is the liability of the central bank, so of our Federal Reserve, right? And so that comes in two main forms, right? And this is also kind of considered the monetary base, right? Base money, M naught or M0, whatever you want to call it. Um, so central bank money again is a liability of the Federal Reserve. Okay. So this would show up as physical cash, and this is the only form of central bank money that like individuals can have, right? Um, the other form is bank reserves, which is their form of digital balances that are held on their accounts at the Federal Reserve, and these are specific like depository institutions. A lot of the times are commercial banks, but other entities can be them as well. And then there's commercial bank money, which is the digital form of money that we the public are used to. This is your bank accounts, right? Um, And then you have non-bank money, which is other forms of digital money held as balances at non-bank financial service providers, as they state. So basically, they don't give specifics on non-bank money, but I'm assuming this is more along the lines of like your private cryptocurrencies and such, and possibly other modes of kind of transferring value. Um, but again, we're more focused on the central bank money and commercial bank money. Um, with some with what I've noticed in this paper with respect to the non-bank money side of things, they're mostly talking about the different technologies and stuff that they're using. And this is where they kind of talk about more of the kind of a pushing off on the private sector for innovation, which again we'll get into later. Um, so this is where I think this part's rather interesting, and I'm just going to read it verbatim just to get it out there. But commercial bank money has very little credit or liquidity risk due to the FDIC, essentially, and supervision and regulation of commercial banks, and commercial banks is access to central bank liquidity. Non-bank money lacks the full range of protections of commercial bank money and therefore generally carries more credit and liquidity risk. Central bank money carries neither credit nor liquidity risks, and is therefore considered the safest form of money. And so this is one of their kind of main distinguishing characteristics between the different types is the types of credit and liquidity risk. So what is liquidity risk? Liquidity risk is like basically, can you even like get the money, right? And so this is like where you deal with like how easy is it for this money to come into being, right? And then there's credit risk, which is your counterparty risk, is like how credit worthy, or like do you have to worry about, say, your bank being able to give you your cash, um, or whatever. Um, and so basically, they're saying non-bank to where it's private, they have at least relatively significant credit and liquidity risk, at least relative to their central bank money or commercial bank money. And then your commercial bank money is again like your bank accounts and stuff, to where you have a little bit, I'd say a little bit more credit and liquidity risk. At least that's what they argue. Um, and they say that the central bank money has none. Um, I think that it could be arguable about the credit risk for central bank money, because I mean you're talking about the credibility of the essentially the central bank itself, or the government in this case, or well, sort of in this case. Um, and that's getting into more of the nuances between like how the Federal Reserve is kind of intertwined with the public sector, but not really in the public sector, and kind of getting into that realm. Um, and one of the things, especially with the credit risk, that kind of pops into my mind is sort of, I don't really see a clear distinguishing factor between the central bank money, for their argument saying there's no credit risk, and then the commercial bank money, to where they say there's a little bit, since the Federal Reserve is so closely tied to commercial banks. um, it's kind of, there's a lot of nuance, and to kind of to finally define that line is difficult to say the least, and would require a lot more, I guess, discussion to really define where that is. Um, so yeah. So central bank money serves as the foundation of the financial system and the overall economy. Commercial bank money and non-bank money are denominated in the same units as central banks, as central bank money, U.S. dollars. That's one thing that people don't. Um, that's People don't think of dollars that way. They think of them as kind of an entity of themselves. But US dollars, like a dollar is just a unit of measure, right? It's a unit of measure of money. So that can show up as the different types of money we're talking about here. That can be talked about. Like if you look into any form of like, I guess, corporate accounting or whatever you want to talk about it, and you see like cash and cash equivalents. And you can put in like short term like T bills in there as well, like treasury bills. What exactly is used as money for like say commercial banks for interbank purposes, right? And so you can look at that. Um, so yeah, and then yeah, denominated in dollars, and yeah, try not to get too sidetracked. And one of the biggest things they said in this paper was mostly with the payment system, right? And so the kind of the main reason the dollar is kind of the world reserve currency is the system it has, right? And that's why it's kind of, I guess, such a big deal, and it has been for at least since Bretton Woods or so. So 60, 80 years or so. Um, but anyways, basically, how would a central bank digital currency change the actual payment system too? Because a lot of people don't go into the nuances of, like, how exactly does this when you transfer money to someone, like, you don't think about it really most of the time. At least most people don't think about it. But like, how exactly is that money going from my account to their account, especially since this the U.S. dollar. So the currencies and stuff are actually just liabilities, right, of some institution, whether it be the bank or a Federal Reserve, right? Um, so how does that liability change depending on whatever type of transaction you're doing? Um, so most payments in the United States rely on interbank payment systems such as the ACH network or wire transfer systems to move money from a sender's account at one bank to a recipient's account at another bank, right? And so, like ACH, dealing with clearinghouses or wire transfers and stuff like that. So how would a central bank digital currency change that? Um, so interbank payment systems may initially settle in commercial bank money or in central bank money, depending on their design. However, because central bank money has no credit or liquidity risk, central bank payment systems tend to underpin interbank payment systems and serve as the backbone of the broader payment system. So basically, using, like, again, when you see these terms of central bank money and then commercial bank money, the difference between those is whose liability is it? Is it the liability of the bank or the liability of the central or of the Federal Reserve, right? And so it's really, when it's talking about the interbank systems, when you're dealing with essentially to say two banks changing liabilities, right? Um, how are they kind of transferring that to one another? Um, yeah. And so, instant, one of the things that they're talking about for really implementing a central bank digital currency would be like instant payments, to where you're not really having much of a settlement process. Um, so, and before I forget, I should note with the interbank payment system, a lot the central bank money they're typically talking about is bank reserves, or at least that's what most people think about for it, on how these transactions are settled across different depository institutions or commercial banks. Um, so essentially, the settlement of transactions between, say, two commercial banks is happening on the books of the Federal Reserve. So it's not having to change institutions, right? Um, in that respect. Um, okay, so with instant payments, they've been particularly active field of private and public sector innovation. For example, the Clearinghouse has developed the RTP network, which is a real-time interbank payment system for lower value payments. The Federal Reserve is now building a new interbank settlement service for instant payments, the FedNow service, um, scheduled to debut in 2023. And the growth of these instant payment services could also reduce the cost and fees associated with certain types of payments, right? Um, Basically saying that, how would this CBDC change um, also the rate at which these payments could have? And because, again, instead of just transacting in, say, the cash on cash equivalents, or so like bank reserves or T bills, depending on what you're doing, um, how does that change with actually like settlement between the banks? So yeah, and then Yeah, growth of non-bank payment services were to cause a large-scale shift of money from commercial banks to non-banks. The resulting lack of equivalent protections that come with commercial bank money could introduce run risk or other instabilities in the financial system. Um, and I'm going to know, right? So basically, oh, go back. Sorry, one sec. um, basically talking about like the integrity of the system itself, right? And so if non-bank payment services were to cause a large scale shift of money from commercial banks to non-banks, so like basically if you were to take almost like if a significant amount of dollars in the commercial banking system, say like consumer deposits or whatever, so that's a liability of the commercial bank, were to transfer over into non-bank money, so say like stable coins or some other like different currency or whatever, um, that would basically that would hurt the commercial bank money, because a lot of the times their deposits are used like this is one of the things that's kind of interesting, at least I think, because you're having a lot of people think that basically we're still in a fractional reserve system with a reserve requirement, which is zero, by the way, now. Um, and so that money that is on like the so your deposits at a commercial bank, and then essentially, I cannot keep my train of thought this morning. Wow. Sorry about that. So the resulting lack of equivalent protections that come with commercial bank money could introduce run risk or other instabilities in the financial system. So it's okay. So I'm kind of grappling with multiple thoughts, mostly with essentially having what degree are consumer deposits like actually like necessary in the system, because they used to be um, very necessary, right? That was kind of the whole foundation of a fractional reserve system, to where you have deposits, or some other like reservable asset or whatever, and then the banks could lend some multiple of that, right? And so, regardless, the consumer deposits were necessary at some point, um, for the banks to lend. But now, according to like other uh, papers and other stuff also from the Federal Reserve, that's not so much the case anymore. Um, and so essentially, by moving all of, or at least a significant portion of commercial bank money, so say consumer deposits, over to or out of the banking system into non-bank entities, they're saying could introduce run risks. So like bank runs, because there's not enough backing of I guess your typical bank run story, to where you have this the banks don't have enough reserves or enough cash or whatever to give out to their uh to fulfill their liabilities per se. And then it could also create like other instabilities in the financial system, basically saying money out of the system's reach is bad. So yeah, sorry for not being able to think this morning for some reason. um So, other challenges involved. So, in particular, a significant amount of Americans currently lack access to digital banking and payment systems. Additionally, some payments, especially cross border payments, remain slow and costly. And this is where we're getting into the financial inclusion part and stuff like that. Um, so, like, here's some actual statistics where it says so more than 7 million, over 5% of the US households remain unbanked. Nearly 20% more have bank accounts, but still rely on more costly financial services such as money orders, check cashing services, and payday loans. And I believe I highlighted. Yeah. So, essentially, among the reasons for being unbanked that they did a survey on it. The FDIC did a survey in October 2020, saying that insufficient funds to meet minimum deposit requirements, distrust of banking or other financial service providers, high fees, and privacy concerns were all reasons some people remain unbanked. Right. Um, this was one of the things too with the whole financial inclusion. I was like, I don't get it. I don't get why it's so hard for some people to just go get a bank account, right? Especially with the insufficient funds. Um, I know, like when I set up my first bank account, I needed like literally $5 to put it in there. So I was like, how do you not? I mean, like if you're an adult having to pay bills and everything else, um, you just put $5 in an account, and I guess it comes maybe it's more of my background of like having at least decent habits or just not having other um I don't know. I don't know people's situations. We're going to leave it at that. But and maybe different banks have different things. I don't know. Um but when I read like distrust in banking or other financial service providers, I was like, okay, that makes more sense. And then high fees and privacy concerns. But that's also like, that's that individual's choice. Like I don't see how you're gonna someone who distrusts the banks and stuff to that extent. Um, I don't really see how, especially a central bank digital currency, is going to change the fact that I don't think it's going to make them actually go get a bank account. That's kind of their own choice. Now, for the first reason, okay, um, everyone's situation is different. I can see where that would be okay. We're just going to leave it at that. Um, But yeah, and then okay, cross-border payments currently face a number of challenges, including slow settlement and high fees and limited accessibility. And so especially if you're doing stuff with foreign countries, there's a lot of legal stuff involved, and things just get even more complicated. Um, and this was where I had a little bit of a light bulb for this kind of concept with the cross-border payments one. So it says. As of the second quarter of 2020, the average cost of sending a remittance from the United States to other countries was 5.41% of the notional value of the transaction. These high costs have a significant impact on households that make remittance transactions. Um, excuse me. High costs for cross border payments also affect smaller businesses that make infrequent global payments to suppliers. Reducing these costs could benefit economic growth, enhance global commerce, and improve international remittances and reduce inequality. And so, for those of you who don't know, a remittance is basically like sending money via mail for payment of goods or goods or services, or as a gift. So, my main thing was like immigrants. Especially for the remittance payments. I mean, a lot of people will like go to come to America, work and send US dollars abroad back home. Um, I actually know quite a few people who do that. Especially like I moved down to Florida and I work as a land surveyor, and so I deal with a lot of people specifically from the Philippines, and they'll do like just that. And I know of other people who do the same thing, just talking around and stuff like that. It's like, okay, that makes sense. Um, Now, like, does this need to be changed? So on. Whether or not it actually needs to be changed, I don't is not an argument that's applicable to this video. Um, and it's also just, I think that was all I had for this. Um, Right. And I mean, in the footnotes too, if you notice, I do actually read the footnotes. And so like G20 countries, so like the big 20 countries throughout the world actually kind of set up a multi-year roadmap to basically fix the cross-border payments issue, or at least try to see what happens. Um, but yeah, stop the screen share. And that's all for this one. But yeah, a lot of the My main reason for going through this white paper and probably other ones as well is really kind of trying to understand the point of a central bank digital currency, right? And like where it kind of plays in things. Um, because like what exactly would it change, right? What exactly would it kind of involve? Like, yes, it's those currency units are now a liability of the. It's essentially making bank reserves available to the public, right? And there's other sections of this paper as well that we'll get into in more in depth in future videos. Basically talking about how the some of the nuances and stuff that they're thinking about is like they'll be able to basically have a cap on how much you can have. Period. Also, like how fast can you accumulate these units, right? And other stuff that's actually like in the paper is them putting a maximum on how much you can actually hold, um, and so on. So now, granted, that depends on if hmm, how easy would that be to transfer into other modes of dollar denominated assets for a person? Who knows? Again, from what I noticed, this paper was mostly just kind of a proposal and kind of a thinking out loud, so to speak, of various other things, looking at it from different angles and putting up options. They did do a kind of a public outreach to where they're quote unquote stakeholders, which I always think is funny. Um, Because if you look into the whole like stakeholder capitalism and everything else and the definition of a stakeholder, right, it's pretty self-explanatory. Anyone who holds stake in whatever they do. So naturally, if you're talking about the world reserve currency to where people are doing these transactions with this money and everything else, everyone's a stakeholder. Um, but they're only asking key ones, and they never define who those key stakeholders are. Um, it's fair enough, but still, I don't know. It still requires a lot of thought. Um, and I'll be on the lookout for more papers and stuff to go into more of the nuances and such. They also in the footnotes they have a lot of links and stuff to the other papers that they're citing and stuff like that. So I'll probably go over some of those as well. But anyways, that's all I got for this one. So I will see you guys on the next one. And there you go.